Hello and welcome to the latest episode of Conversations on the Couch here at Empire. The scale of funds that we manage here at Empire and the collective experience and reach of the members of our investment committee mean that we often have access to investment solutions that aren't available to other advisors, or often if they are available to other advisors, they're available to us at preferential rates as a result of the scale that we can bring to our clients. It also means that we have access to the people at the very top of these fund managers, and as you've seen in some of our previous episodes, the opportunity for us to have these one-on-one conversations with the people who make the decisions within those funds. Today, I have the very distinct pleasure of having Simon Doyle here, who is not only the Chief Investment Officer, also the Chief Executive Officer of Schroders. So when Simon first agreed to speak to us and we booked it in, he was the Chief Investment Officer since June.
Correct.
So a little bit over a month now, he was appointed CEO. So welcome along, and first of all, congratulations on the new appointment.
Yeah, no, thank you. It's been a busy month, but after I've been at Schroders for 20 years, so it's actually a real pleasure to lead the business here in Australia in a broader capacity.
So you are the epitome of the saying that it takes 20 years to become an overnight success.
Oh, it's a bit longer than that actually. I've been sort of 35 years in this industry. So I started probably in a way at the bottom. I was in operations counting share certificates back in my AMP days. So it's been a really interesting journey, but really pleased to be here today.
Yeah, wonderful, thank you. We have the Schroders Real Return Fund within the Empire portfolios. The Real Return Fund is a multi-asset fund.
Right.
So I guess these multi-asset funds and alternative investment funds can sometimes be difficult for investors to understand. So can you start by telling us what the Real Return Fund is and what it's trying to accomplish for investors?
Yeah, sure. So I've had the pleasure of I started the Real Return Fund back in 2008, so in the middle of the global financial crisis. The objective of the fund was to really try and deliver consistent returns to clients. So rather than see big swings in market prices or into the unit prices, returns to the investor because equity markets went up and down, to try and smooth that out. So we wanted consistent returns, relatively low volatility, and to minimise those particularly the downside that can occur when you get those sort of periods of volatility in markets. As a multi-asset strategy, it's actually relatively simple. It's not a complicated strategy. We're constructing a portfolio with generally normal assets, equities, fixed income, cash, but also a range of other assets. We have access, given out the sort of breadth of our global platform, to a lot of different investments in different countries, in different types of assets that we can bring to bear on the portfolio. So essentially our task is to put those assets together in a way that delivers, in our view, those objectives: a consistent rate of return that's independent of the business cycle, that can achieve, as I say, consistency for clients using that sort of broad array of asset classes.
Okay. So you've got this broad asset class in there. What sort of process does the team behind the Real Return Fund? What do you do to determine which assets and in what mix you're going to be allocating them in the portfolio? And particularly, I guess, some of the more unusual asset classes that perhaps investors aren't on a retail level as familiar with.
Yeah, sure. So I guess if we're thinking about delivering consistent returns, we need to have a way of assessing what an asset class is likely to deliver going forward. Because what happened yesterday doesn't matter; it's what happens tomorrow that's really important. And so essentially, what we do is we use valuation to give us a guide as to future returns and also future risk. And it's pretty simple, really. I mean, if we buy an asset, we pay a lot for it. If it's expensive when we buy it, it's going to be much harder for us to make money. The risks of actually losing money are going to be greater. If we buy assets when they're cheap or appropriately priced, it's more likely that we're going to generate decent returns from those asset classes and the risks are low. So everything we do, we really put through a valuation screen that sort of tells us something about the future return and something about the risk. Now, some assets are a bit harder to apply that to. So we have access to a broad array of investments. So everything from typical public markets, so equities, government bonds, corporate bonds, cash and currency. But we also have a very large platform in some private markets, for example. So direct lending to businesses, direct, lending to sort of commercial real estate, where we can generate areas that banks are not involved in, that we can provide capital to and earn decent returns, as well as having operations in a range of developed and emerging markets, so access to emerging market equities, which, in the current environment where the world is, probably a bit more desynchronized, and there are different opportunities in those markets, we can capture those markets. And I think importantly, we have capability, so we have teams of specialist investors in all those areas. So, my job, or my old job and my team's job, is to make these decisions as to what we own, which assets, where do we want to be, where are the returns, and then we have specialist teams who their day-to-day job is to find the best investments within those markets, and they know those markets very well.
And when you talk about emerging markets, what sort of markets in particular are an area of focus at the moment?
There's sort of focus in two ways. One is those markets that are likely to generate good returns in a world that's changing. As we're seeing, supply chains disrupted, sort of through COVID, through sort of geopolitics, and governments and businesses are investing in places like Mexico, Thailand, those sorts of markets that are actually relatively developed, but less developed than places like the US and the UK and so on. And so those markets will benefit from shifting trends in production, from sort of broader growth trends that are sort of occurring in the world. So, outside the big markets, where I think we're seeing investment occurring, and we think over time good returns.
Okay. There's lots of talk about the global economic position and
Yes.
With rising interest rates and combating inflation and fears of recessions and all of those things that analysts are contending with every day. What's your or Schroder's position on the current macroeconomic conditions, and what's occurring therefore within the Real Return Fund to respond to where you see macroeconomic conditions heading?
Yeah, well, certainly, that's a question we get asked a lot, and it's a really important one because I think there's a lot of talk about recession, and while we can see evidence of elements of a recession, maybe in construction, for example, there's not clear evidence that we're actually in one, and so people are sort of, where is this recession that we've been talking about? Now, our view is it's coming. Certainly, a fairly pronounced downturn is coming, both here and in key places like the US. Why is that? Well, we've seen a very significant increase in interest rates. Now, the first thing I learned in economics was that interest rates take a while to flow through. The lags between policy changes and the impact on economies, can take 1 to 2 years to flow through. And the rate rises that we've seen started from such a very low level that's really taken a while for them to get to a point where they're starting to bite. We're starting to see evidence of that in Australia, people sort of rolling from fixed rate mortgages at very low levels to higher levels, more distress starting to come through, and those pressures, are starting to build. We think they'll become more evident through the back half of this year into early next year. The other factor has been that because of the COVID crisis, a lot of money was handed out to people to support them, keep them in jobs, provide cash flow, when economies were shut down. Those cash buffers have supported consumers for a while. People have been able to sort of draw down on that accumulated saving, but that's now starting to run out. So we think the combination of, now we're at a point where we've got high interest rates, We've got central banks committed to slowing economies because they their job is to get inflation down. So we think that's going to bite in the next, probably next 3 to 6 months. Why are they doing that? Well, they need to get inflation down. We think inflation has probably peaked, but it's going to be a slow grind. Anyone who thinks inflation's coming back to 2% quickly, I think is going to be disappointed on that. And what does that mean? It means interest rates are likely to stay higher for longer, and we think there's probably another, so 1 to 2 interest rate increases likely to occur here in Australia before the cycle's done. And then I think it will be a slow grind lower. We're certainly not going back to the levels that prevailed, 1 to 2 years ago. Mm-hmm. So, we might be sort of through the worst of the pain for interest rate rises, but don't expect that sort of rate relief to come quickly. And a lot of that pain has been felt in markets already in fixed income assets that have repriced as yields have gone higher. But we do think that equity markets are still vulnerable, as profit growth weakens in response to that slowdown in the economy. So how are we positioned for that? Well, we're actually positioning for that scenario, for recession. The real return strategy is very active in terms of asset allocation, and that's the key lever we have to really control risk and exposure. We currently have around 15% of that portfolio in equities. Now, go back 18 months ago to 2 years ago, we had about just under 40% in equities. So we've cut back on that risk, and we've also been increasing our exposure to government bonds, which are a safe asset, will do well in a period of recession, and we have about 30% of the portfolio in cash, earning around sort of 4.5%. So we're positioned for recession, but having that cash means as that volatility unfolds, we can then buy equities when they're cheap. Yeah. And that's how, that sort of combination of managing asset allocation helps us protect the downside, but puts us in a position to capture the upside when it's, when that's most likely to occur.
I'm sure you could elaborate on that answer for a lot of time to come. We are limited on time, but fascinating conversation. Of course, anything that you hear today, if there's anything else that you'd like to learn about, any of the Empire advisors are on hand to discuss the place of the Schroders Real Return Fund in our portfolios. So please give us a call for any further queries with regards to that fund or anything else within our portfolios. Thank you for listening today.